sale of interest in companies. So there is a very famous example, Lucent, a technology company, when it was restructured, it sold a portfolio of a very large portfolio of about 50 companies on the market, and that actually kicked off what's called the portfolio direct or direct secondary market. Now, even more recently, we have a new market, more the one that Mike and Internet Security is focusing on, which is the sale of individual companies. An example is, for instance, an employee of a company like Lyft, say, and they want to buy a house and they want liquidity, so they put some of their shares on the secondary market, and that is a relatively new market. So briefly, the benefit to the seller here. So we discussed about the three situations already. Another case can be a public function fund, for instance, who want to reduce the amount of investment they have in private equity compared to the rest of their assets. It can be an endowment, sometimes endowment who have been investing in this business for like 20, 25 years, have portfolios of 200, 300 GPs, and at some point they need to cut the monitoring cost, and they decide to reduce it to by half or by 1/3. Another example that created a lot of activity in the secondary market is European regulations, for instance, Basel III, which require the certain banks not to own illiquid assets, and so there was a lot of sale following Basel II and I think Basel III regulations. So all this led to a very rapid growth of the secondary market. I just put the past 10 years. The 2015 numbers are actually they are about the same at 2014, so you're talking about 35 billion, and starting at 7 billion in 2003. Why is that? Well, there is first the growth of the private equity market in general, primary market, and on top of that, the base of sellers at the beginning was distressed sellers, but now it's much broader than that. The base of sellers has expanded, and so we moved from about 2% secondary market to 6% expressed as a percentage of the primary market. So very rapid growth and should continue. Now, secondary performance, that's more from the buyer. So why would people invest in the secondary space? In terms of performance, this is a little bit, this is a table, a sample that stops in 2008 because it focuses on mature fund. So that's why the numbers that you see in the primary funds, on the left side you have the multiple, on the right side you have the IRR, and you have the secondary fund and the primary fund. So obviously the performance of the primary fund is impacted by the underperformance of VC until 2008, but that should improve if you look at a more recent number in terms of funds or newer funds. It will it will be higher than that. But the reason why they use fund until 2008 is because they're working on the mature fund, which is the focus of secondaries. So anyway, so as you can see, secondary has done very well. The median it has 1.4, which is pretty good. The other thing is that it's a much more concentrated asset class. So where you see the primary fund going from the worst 0 to 28 times, the secondary fund goes from 0.8 to 2.5. So much narrower band, which gives the investor a very good downside protection. And also reduced volatility. The other interesting thing with the secondary funds is that they have a net IRR and IRR which is much higher than the primary fund, and that it's always the case because you invest at a later stage of the life of the fund. So as you can see, for instance, in the top quartile, the secondary fund will have an IRR of 19.8 and the primary fund 12.8. So now, moving to secondary pricing. So how does it work? So let's look first at the two charts. So the two charts present the price on average paid by secondary buyers to secondary sellers. So for instance, in the upper chart, buyout pricing, in 2007, secondary funds were buying assets at 9% over the NAV, which is very high. And as you can see, with the financial crisis, it collapsed, went down to, in 2009, 59%, and then quickly recovered, and now it's stable around 90 to 95, which is 20% discount, 5 to 10% discount. That's for the buyout. If you look now at venture capital, same shape, except that the prices are lower because you're buying at around 80 cents to the dollar, so a 20% discount. So these numbers are obviously driven by market factors like the market sentiment, but also the supply and demand. If some secondary fund raise more money, they will pay, they will have to deploy it, they will offer higher prices. It's also depend on the assets. So that's the difference between the chart for buyout and the chart for VC. The difference reflects that VC is obviously more risky than buyout, and so secondary players will pay a lower price. So how do we calculate a secondary price? So basically, let's take the example of a 500 million fund with 4 companies left. And we own 1% of this fund. So today, the NAV, the value of our share, is 5 million, so 1% of 500. So if, as a secondary buyer, we think, after running analysis of the companies, we think that the 4 companies can be sold over time for 700 million, we think that the interest we're buying will generate 7 million for us, 1% of 700. And if we are promised, or we want a target multiple of 1.6, well, we have to buy it for 7 million divided by 1.6, which is 4.38 million, which is a 12% discount to the 5 million. So that's secondary, the way it works. Now, if we have a more aggressive projections, we have better perception of the assets, we can imagine that they will generate 8 million. 800 million and 8 million for us. So then we actually don't need to have a discount, because 8 million divided by 1.6 is 5 million. And if we do the same calculation, but this time we do 7 million divided by a multiple of 2, then we get 3.5, which is a 30% discount. And this is what discount is about. But from the seller standpoint, you always have to look at what you got before, because the past distributions is very different. If when you sell your interest, you have already a multiple of 1.8 on your investment, obviously you're going to be much less sensitive than if you are a multiple of 0.8, where you become very sensitive to the price that you're giving. So it's very important for a secondary seller to look at the overall cash flow situation. So moving to technology secondaries. So what are the recent trends? So what we're seeing now is, I think, kind of unique, because we are seeing a very, very large market that's being created. The amount invested in private equity and venture capital is now like $1 trillion. And to give you an example, the valuation of the unicorns as a whole is like 500 billion. The NASDAQ today has a total market cap of 7.5 trillion. So the valuation of the private companies has become a significant part of the total value, with not immediate liquidity. So liquidity is going to become a real question, And so everybody can answer liquidity issues like we are trying to do here will be really helping the market. Another element is that the base of investors has enormous change, is changing now, especially in the venture capital space. Before it was venture fund, I think 100% of the investments were made by venture fund. Now, I mean, I was talking to a friend who is in the corporate venture, they calculated that about half of the investment in technology is made by non-VC investors, which mean, you know, high net worth individuals, sometimes it can be employees, and obviously angel investors. And these people have very different perception and very different needs from, obviously, endowments and foundation. And oftentimes, the holding period is obviously shorter than endowment. So that should have a big impact on the market. In terms of size, well, it's going to continue to grow because it's like a tank where the flow, you know, the money pouring in is actually coming faster than the money getting out because there is not enough companies sold. So the tank keeps, you know, increasing, and so we estimate today that it's about 10,000 companies, good quality companies, that are on the market with investors but no real liquidity. So that means that the market is going to continue to grow rapidly. So, you know, in conclusion, what can we say? For sure, the volume is going to continue to grow. In terms of timing, we saw the cycles in the pricing. I think we're reaching now a time when people are starting to sell. There was a sale that was announced in the press by Intel, not confirmed, so maybe just, you know, news. But anyway, people start selling, so that's important. There will be large amounts of sales by individual investors, and so for secondary buyers, there will be interesting opportunities. And as usual, because of the involvement of the individual investors, there may be new regulations that will come up after a while. And that concludes this short presentation on the secondary market.
I'd like to open it up for questions to Emmanuel.
Yes.
A couple of questions. One is you're talking here about NABs. In this context, what are the NABs? Is it based typically on last financing round? Is it whatever the investment bankers pull out of thin air? What's typically the... You mean you by NAV and showing a graph of NAV, what's behind it?
Yes, absolutely. So NAV is so it's the last. Usually there are rules. There are rules. It was not the case like 10 years ago, but now there are rules. The rules that it's the last round. So they can be. I think if there are some market events like a sale, you can use that. But usually it will be the last round by default. And the NAV are prepared by usually the investors, so the venture capital funds, that have to issue reports that are GAAP compliant. And so they follow relatively strict rules. And we can see it because sometimes the same company is owned by different VCs. There will be like 2 or 3 VCs. And sometimes we have access to the 2 or 3 reports. In the past, they were like very wide, very broad variation. Like one VC would say it's worth like 10 million, other one would say it's worth 30 million. We see much less of that. So it shows that it's become much more regular.
So in all these cases where you say there is some discount to NAV, so that NAV, if it's based on past rounds, then it does not include any expectations for any appreciation that it's happened since last round, does not include any appreciation for any multiple relative to the NAV, but actually it shows less than 1 multiple relative to the last round.
Yes, okay. Exactly. And sometimes you can see, up round and but you need usually an event, and some, for instance, in the private equity market, it's slightly different because you don't have round. You come in at a certain price, and then you can be 6 years later, nothing has happened at the equity level. So then you have to use multiples, and then you have a little bit of more. You can take into account the the recent performance of the company.
Yeah, a completely different question in the last slide, or one before last. You're saying Surgeon starts to sell. An example, Intel starting to sell. Why? Why would they sell now?
Well, in the case of Intel, it's the CEO. There is a new CEO who decided that they won't make. I don't know exactly, but they won't make investments. So this is corporate venture. So corporate venture has certain rules which depend on the strategy, and that's why it's a market that's moving a lot, because some CEO is going to find that it's very interesting to invest in a non-control position in companies, and another one is going to come like 5 years later and think it's not a good idea, and maybe it's a good idea, maybe not, but they decide, and then sometimes they invest, sometimes they divest.
But the bullet saying in general, investor starts to sell. So, I mean, is there a specific trend that you see now? Or?
Yeah, I think you feel a trend, on the valuations. Yeah, you feel that start having a bit of pressure. People think that the valuations are a bit high. I think that's the reality in the market. That means, but we're talking with private companies, so as you know, it can be, you can decide otherwise. So it's everybody's decision.
Emmanuel, I have a question. You had said that about half the technology investment is from non-venture capitalists. So that implies
that's the number I heard.
Trim a friend of yours, corporate VCs, high net worth individual, angel investors, etc. Any sense for what percentage of technology investing, including follow-on transactions, would be secondary transactions?
Yeah, in the past, and I think it's still the case now, we saw numbers around 5 to 10%. My experience, I don't think it's going to be very different from that. It's a market that is surprisingly stable. So I think, and a lot of people don't know that they can sell the secondary market. They're not even aware of that. And we are always surprised when we talk to certain categories of investors that they don't know that they can sell the secondary market.
Yeah, along those lines, I'm interested in the liquidity. Is it often built into the original investment, or as this secondary market grows, are the originating deals changing and that they're anticipating some of this secondary market activity?
You mean the companies?
The contracts, yeah.
The companies.
Well, when there's an initial investment, the deal, and as this secondary market grows, are these deals changing and that they're anticipating some of this activity?
I think it's totally independent. So, to give you an example, if you make an investment in a technology company in a Series D round, nobody has any idea about what's going to happen to the security from a secondary standpoint. There is only a few funds, new funds like Sven will speak about later, have actually in the structure of the fund, they have built a secondary, like a liquidity mechanism. But venture capital funds and companies don't have liquidity mechanism. Only listed companies do, but not private fund companies. Yeah.
So, approximately how big is the buying of limited partnership interests versus the sort of new thing, the buying of secondaries in companies? And then, are the pricings tracking pretty much the same?
So it's about depends. We actually, I didn't mention it. It's actually in this chart, no, this one here, but I didn't. So the gray numbers are the numbers for the direct secondaries, and it's more the portfolio acquisitions. So as you can see, it can be anything from it varies a lot depending on the big deals that happen on each particular year. But you can imagine anything between 5 and 25% depending on the year. The third this category at the bottom, so the direct company direct, that I don't have number on. We were not able to find. We're looking for numbers, but we haven't found any numbers yet.
So the slides that you showed about return, is it on a kind of like specific asset class, for example, private equity of venture-funded companies, or does it include other wide things of private equity in, I don't know, cash flow tools, or it's really mostly for VC-funded companies?
What is sorry,
Is it mostly on VC-funded companies?
Yes, so yeah, exactly. So yes, and mostly non-control position. So this number would not include, for instance, let's say there is a private equity fund that has an investment to cover, a company, manufacturing company owns 70% manufacturing company. 5 years later, they sell it to another private equity fund. And that's not included. That's another type of second.
Yeah, so in those things, if I correctly remember, the shown returns there on the average, something in the order of under 10% for the primary funds, and in the order of 15% for the secondary acquisitions. Did I get that right? The average returns.
Oh, the returns?
Yeah.
Yeah, let me look at the return. You mean this chart here?
Yeah.
Yeah. So yeah, that's the returns of the between secondary funds and primary funds, and the as I said, the primary funds are a little bit impacted by the fact that VC hasn't done well, didn't do well until 2008, and then picking up. So, and those are all the funds. They are funds that, the secondary buyers would focus on. They are funds which is from 90 to 2008. So by definition, they're older. So the number on the primary fund, I think, is a bit underestimated. At present. But this has to compare primary and secondary.
So this secondary return is starting at 2008? Sorry? The number for secondary funds, like average 15 point something%.
That's a fund, exactly, that's vintage. So that's a fund that was started from 90 to 2008. So that's, we're talking about all the funds. So for instance, funds that were raised in 09, 10 are not included.
So second, okay, maybe I do not understand the slide. When you say here secondary funds, does it mean the net IRR for those that acquired in the secondary market, the portions of the primary funds that have been earlier, and the acquisitions that made from 2008 and onwards?
Yeah, so that would be for funds that is by vintage. So indeed, for the primary fund, it would be funds that have invested, that have been launched until 2008.
Okay.
So
the secondary investments have been made from 2008 and onwards.
And before, 90 to 2008. This is 90 from 1990 to 2008. So it's they basically focus their study on older funds, and that's we are actually doing a study at the moment, which is slightly different, but the numbers are about the same. Like the profile is the same, very concentrated performance for the secondary fund, and very high IRR, much higher IRR.
Well, thank you, Emmanuel.